You interact with it probably, I don't know, 5, maybe 10 times a day.
Oh, easily, at least.
Right. You tap a piece of plastic against a terminal, or you double-click the side button on your phone, or, an invisible subscription just renews in the background while you sleep.
Yeah, the ones we always forget to cancel.
Exactly. And most of us, we just never give a second thought to the sheer mechanical scale of what happens in the milliseconds after that tap.
Mm-hmm.
But today, we're going to look under the hood of what I like to call the ultimate global toll booth.
It really is a toll booth, yeah.
We have our hands on Visa's official fiscal second quarter 2026 results, which were just released yesterday, April 28th, 2026. And the mission today for this deep dive is to, well, cut through all the macroeconomic noise.
Which there is a lot of right now.
So much noise. So by unpacking Visa's massive $11.2 billion quarter, we are going to extract the raw truth about the global consumer. We'll decode a very aggressive pivot they're making into AI and stablecoins and break down the financial engineering required to manage billions in spare cash.
And their legal liabilities, which is a huge part of the story. But, Visa is arguably the most accurate real-time mirror of the global economy we have.
How so? Like more than government data.
Oh, absolutely. When a single network processes the sheer volume of commerce that Visa does, you are no longer relying on sentiment surveys or, those delayed government economic reports that get revised 3 times.
Oh, right. Okay.
You are looking at the actual indisputable velocity of global money. It's what people are actually doing, not what they say they're doing.
Okay, let's unpack this then, because the scale of the Q2 2026 numbers is just difficult to wrap your head around. Net revenue hit $11.2 billion.
Yeah.
That is a 17% increase year over year. And even if you strip out currency fluctuations and look at constant dollars, it's still 16% growth.
Which is massive for a company of that size.
Right. And the CEO, Ryan McInerney, he highlighted that this 17% revenue jump is actually their highest since 2022. On the bottom line, GAAP net income came in at a clean $6.0 billion. That's a 32% increase.
Well, to understand the mechanics behind margins like that, you really have to look at the throughput of the network, because to generate that $11.2 billion, Visa processed 66.1 billion transactions.
Wait, 66 billion? In just 3 months?
In just 3 months, yeah. That's a 9% increase from the prior year, if you run the math on that.
I can't even.
It's crazy. They are routing, clearing, and settling over 8,000 individual transactions every single second of every day.
8,000 a second. Wow.
Yeah, and payments volume overall grew by 9%.
And the high margin traffic is surging too. I mean, looking at the cross-border volume, that surged by 12% overall. And even if you exclude transactions happening within Europe, because I know those operate under different fee structures, cross-border volume is still up 11%.
Right, and that specific metric, that's the golden goose for payment networks.
The cross-border stuff.
Exactly. Because cross-border transactions are incredibly complex. I mean, they involve multiple currency conversions, you're navigating different international banking regulations, and assuming different settlement risks across borders.
So they can charge more for it.
Precisely. Because of all that friction, Visa can charge significantly higher network fees and foreign exchange spreads. So that 12% surge in volume, that drove their international transaction revenue up 10% to $3.6 billion.
Which proves that international travel and, global e-commerce are not just recovering anymore. They're compounding.
Yeah, they're accelerating.
I always look at this business model and think of the ultimate superhighway. They don't manufacture the cars.
No cars.
They don't pave the physical asphalt. They don't even sell the fuel. They just maintain the toll booths, taking a microscopic fraction of a cent for every single car that passes. And with 17% revenue growth and 66 billion cars passing through, the highway is packed.
The highway is very packed.
So what does this all mean for the macroeconomic picture? Because we see so many headlines right now in early 2026 about consumer exhaustion, inflation fatigue, people running out of savings.
What's really fascinating here is the stark divergence between what consumers say in surveys and what they actually do at the checkout counter.
Totally.
Ryan McInerney stated explicitly in the earnings release that, quote, consumer spending remained resilient. The raw data, the literal physical tapping and swiping, shows absolutely no sign of a broad macroeconomic pullback.
They're still spending.
They are. But And this is key. The growth isn't just coming from the authorization of payments. It's coming from the whole ecosystem built around those payments.
The extra services.
Right. Their data processing revenue rose 18% to $5.5 billion. And crucially, what they categorize as value-added services, that rose a staggering 41% to $1.3 billion.
Okay, I want to dig into that value-added services piece because it ties directly into a very specific tech-heavy quote from the CEO that caught my eye.
The hyperscaler comment.
Yes, he talked about enhancing their Visa as a service stack,
Yeah.
and he explicitly mentioned adding agentic and stablecoin capabilities to further strengthen their position as the leading hyperscaler of payments globally.
It's quite a sentence.
Right. Now, I have to push back on this framing just a bit. My buzzword bingo card is completely full here.
Oh, I'm sure it is.
We have agentic, which refers to autonomous AI agents. We have stablecoins, meaning crypto that's pegged to fiat currency. And we have hyperscaler, a term that almost exclusively belongs to cloud infrastructure giants like Amazon Web Services or Microsoft Azure.
Traditionally, yes.
So I look at this and I wonder, are they just throwing 2026 tech buzzwords into an earnings call to, artificially juice the stock for Wall Street? Or is a 65-year-old credit card company genuinely fundamentally restructuring its architecture?
Well, I get the skepticism. It is very easy to be cynical about corporate jargon. But if we actually analyze the underlying architecture they are building right now, the hyperscaler label is structurally accurate.
Really? You think so?
I do. Think about what a cloud hyperscaler actually does. AWS provides the invisible compute and storage utility that allows a company like Netflix or Uber to even exist.
Okay, sure.
Visa is signaling that they are transitioning from being a consumer-facing plastic card brand to being the invisible underlying utility for all digital value transfer.
So they just want to be the foundational plumbing, regardless of what the water looks like.
Exactly. The water can be anything. When they report a 41% increase in value-added services, that represents things like fraud prevention APIs, digital identity verification, risk scoring. They are essentially selling the cloud infrastructure of trust.
Ah, the infrastructure of trust. I like that. What about the stablecoin part, though?
When they mention stablecoins, they are acknowledging a fundamental shift in settlement mechanics. Traditional money moves on what's called T+2 settlement. It takes 2 days for banks to reconcile.
Right, it's slow.
Very slow. But stablecoins on a blockchain settle instantly, 24/7. Visa doesn't want to fight the blockchain. They want their network to be the routing layer that bridges traditional fiat bank accounts with instant crypto settlement.
Okay, that makes sense. But what about the agentic capabilities? This implies they are building for a future where the consumer isn't even a human being.
And that is probably the most radical shift in their strategy.
Really?
Yeah, think about it. A human being has a physical wallet and a leather purse. An AI agent does not.
Good point.
As we move toward autonomous AI supply chain managers that, say, order inventory on their own, or personal AI assistants that negotiate and switch your streaming subscriptions automatically, those AIs need a programmable, tokenized credential to execute transactions.
They need a way to pay.
Exactly. Visa is aggressively building the API endpoints so that when an AI agent decides to spend money, it just defaults to using Visa's rails to do it. They are upgrading the toll booth to accommodate machine-to-machine commerce.
Wow. Upgrading the toll booth for machines. That is a brilliant way to frame it. But here is the paradox, I think, of being a global hyperscaler. You can build all the beautiful cloud APIs and AI infrastructure you want, but money ultimately has to settle in the physical world.
Oh, absolutely. You need those physical off-ramps.
Right. You need local endpoints. Which brings us to a major strategic move they just completed in Argentina this past February. They acquired Prisma Medios de Pago and NuPay.
Yes, and if you look at the specific assets acquired in that deal, it perfectly illustrates that tension between global infrastructure and local reality.
What exactly did they buy?
Well, with Prisma, they acquired traditional credit, debit, and prepaid issuer processing. But NuPay is the real strategic linchpin here.
Why is that?
Because NuPay operates the Benelco ATM network, a highly dominant bill payment platform down there called Pago Mis Cuentas, and crucially, real-time payment services.
Okay, here's where it gets really interesting to me. Going back to our highway analogy from earlier. Visa already owns the massive multi-lane global superhighway that connects continents.
Right.
And we know that cross-border traffic is booming, up 12%. But buying the Benelco ATM network in Pago Mis Cuentas, that's like buying the local neighborhood roads, the suburban driveways, and the local parking meters in Argentina.
Exactly. If we connect this to the bigger picture, it reveals a very smart defensive strategy against disintermediation.
Disintermediation, meaning getting cut out of the loop.
Yes. The single greatest structural threat to Visa's global duopoly right now isn't another credit card company like MasterCard, it's domestic real-time payment network.
Oh, like what happened in Brazil.
Exactly. We've seen this with PIX in Brazil. Central banks and local governments are building direct bank-to-bank payment rails that bypass card networks entirely, which effectively cuts Visa out of the transaction.
Right. Because if a consumer in Buenos Aires transfers money instantly from their bank app to the grocery store's bank app using a domestic real-time rail, no one is paying Visa a swipe fee.
Precisely the threat. So by acquiring NewPay, Visa's literally buying the domestic real-time payment rails themselves.
Wow.
They are neutralizing the threat of disintermediation by simply owning the disintermediator.
If you can't beat them, buy them.
Exactly. And integrating a platform like Pago Mis Cuentas is a masterstroke in capturing everyday velocity.
That's the bill payment one, right?
Yeah. Bill payment is incredibly sticky. Once a consumer mandates a direct debit for their electricity or their water bill, they almost never change it.
I know. I haven't touched mine in years.
Right. It provides highly predictable, recurring domestic volume that insulates Visa from, say, global macroeconomic shocks.
So they capture the high-margin cross-border traveler at the airport, and they capture the local resident paying their water bill on their phone in the suburbs. Total capture.
Total capture.
But maintaining this kind of global supremacy developing AI APIs while simultaneously buying up physical ATM networks in South America, that generates a staggering amount of free cash flow. And how they manage that capital is practically a business unto itself.
Ooh, capital allocation at hyperscale is where the financial engineering becomes just as critical as the software engineering.
Let's look at the raw numbers from Q2 on this because it's wild. In just 90 days, Visa deployed $9.2 billion towards share repurchases and dividends.
$9.2 billion.
In one quarter.
Yeah. They bought back roughly 25 million shares of their Class A common stock at an average price of around $320. And on top of that, the board of directors authorized a brand new multi-year share repurchase program of $20 billion.
$20 billion more.
Yes, which sits on top of the $13.2 billion they already had left over from previous authorizations.
It is an aggressive, sustained contraction of their equity base.
Can you explain why they do that so aggressively? Well, by constantly retiring shares, taking them off the open market, they mathematically increase the earnings per share for the remaining stockholders.
Right. A smaller pie means bigger slices.
Exactly. Which is a massive driver of their stock price valuation.
But here is the piece of the puzzle that requires some deduction, I think. We know they are sitting on $14.2 billion in cash and investment securities.
They're flush with cash.
Right. And we know they are throwing tens of billions at buybacks. Yet, in February 2026, Visa went to the debt markets and issued $3 billion in fixed-rate senior notes.
Yep.
They are borrowing money with interest rates ranging from 3.8% up to 4.7%. Now, if I look at this strictly from a corporate finance perspective, I have to assume they aren't borrowing because they need liquidity, right? They are optimizing their weighted average cost of capital, their WACC, and utilizing tax shields.
That is spot on. And this raises an important question about how legacy monopolies manage their balance sheets. You are absolutely right on the mechanics.
So it is about the taxes.
Partially. Corporate debt interest is generally tax deductible. By maintaining a specific ratio of debt to equity, they lower their overall cost of capital. But there is also a maturity management aspect here.
What do you mean by maturity management?
Well, the earnings release explicitly notes the debt is for general corporate purposes, which includes refinancing existing indebtedness.
Oh, okay.
If they have older tranches of debt coming due, they issue new notes to pay them off. They are effectively rolling the debt forward and managing their liability timeline.
So it's just cheaper to borrow $3 billion at 4.7% and deduct the interest than it is to, say, repatriate cash from overseas or halt their equity buyback engine.
Much cheaper, yeah.
But there is another massive line item in their expenses that I noticed, and it really shows the true cost of maintaining this kind of market dominance, the legal moat.
Oh, the antitrust and litigation landscape. That is the permanent shadow hanging over all the payment networks.
It's huge. In this quarter alone, Visa recorded a special item of $311 million for litigation provision. And this is primarily associated with the interchange multi-district litigation, the MDL.
Just another cost of doing business for them.
Right. And that is just one quarter. I saw they had a litigation provision of nearly $1 billion, 992 million, I think, in the same quarter last year. Plus, they just deposited another $125 million into a litigation escrow account under their U.S. retrospective responsibility plan.
Think about the mechanics here. The core of Visa's revenue model relies on the interchange fee, the swipe fee charged to merchants.
The toll.
The toll. And merchants have spent the last 2 decades fighting these fees in court, arguing that Visa and MasterCard operate an illegal duopoly that essentially fixes prices.
Because merchants have no choice but to accept Visa.
Right. And because Visa processes trillions of dollars, a fraction of a percent in disputed fees translates to multi-billion-dollar class action lawsuits.
So the escrow accounts are just a defense mechanism.
Exactly. The escrow accounts and these massive quarterly provisions are financial shock absorbers. They are deliberately trapping capital to insulate their common stockholders from the existential risk of a massive surprise court judgment.
It really paints a complete picture of what it takes to run a modern economic titan. You aren't just writing code.
Far from it.
You are balancing billions in stock buybacks to satisfy Wall Street, managing a complex debt portfolio to optimize your tax burden, and provisioning hundreds of millions of dollars in cash just to survive the endless war of attrition with merchants and regulators.
It's a massive juggling act.
We have covered a lot of ground today, pulling apart the machinery of a quarter that generated $11.2 billion. Let's synthesize the core takeaways from the raw data for everyone listening.
Sure.
First, the actual velocity of money tells us the global consumer is highly resilient. 66 billion transactions drove a 17% revenue increase, defying all those pessimistic sentiment surveys out there.
The data doesn't lie.
All right. Second, the fundamental nature of the network is shifting. Visa is building the API infrastructure to act as a digital hyperscaler, bridging fiat with stablecoins, and preparing for autonomous AI commerce.
The invisible utility.
Yep. Third, they are aggressively moving to own the local endpoints. They are neutralizing the threat of real-time payment networks by acquiring domestic infrastructure directly, like they did in Argentina.
Owning the driveway.
Exactly. And lastly, their financial engineering is just a masterclass in capital allocation. They're utilizing debt tax shields while returning tens of billions to shareholders and mathematically isolating their massive litigation risks.
It is a phenomenal balancing act between extracting value from the present and architecting the plumbing for the future.
Very well said.
And as we wrap up, I want to leave you with a thought regarding that future, specifically concerning those agentic capabilities we discussed earlier.
The AI agents.
Yes. For the entire history of modern commerce, the friction of payment has been human. A human mind decides to purchase, and a human hand literally pulls out a card or taps a phone to authorize it. But if Visa is successfully building the API endpoints for AI agent software that can negotiate contracts, optimize supply chains, and execute stablecoin payments autonomously 24/7, we are approaching a major inflection point.
We really are.
Consider this. In a decade, what percentage of Visa's quarterly transactions will be initiated without a single human being ever making a conscious decision to spend money?
That is wild to think about. The moment the majority of global commerce becomes machine-to-machine, the toll booth becomes entirely invisible. Thank you for joining us on this deep dive into the raw data. The next time a subscription auto-renews or you tap your phone for a coffee, take a second to consider the massive global infrastructure executing that settlement in milliseconds. Keep questioning the systems running the world around you, and we will catch you on the next deep dive.